reporting, we understands we can say the different financial statements which we required for the financial reporting purpose. Okay, so financial reporting, we see in the last session that financial reporting is nothing but we can say a well structured document which show the financial position of the organization. Okay, in financial position, as we say, that is the assets and liability positions we checked in a balance sheet. Okay, we see that if the assets are greater than the liabilities, then the organization is in a good position. Same likewise, in income statement or in a profit and loss account statements, we will check that the organization is in a loss or is in a profit. Okay, same likewise in cash flow statements, we check, we can say the cash flows at the different intervals of the organizations. Okay, and last financial statement is we can see the changes in the equity statements. In that statements, we checked it out that the equities of the owner of the organizations or the shareholders of the organization is increases or decreases. Okay, and we understand we can say the different what we are going to study in the subjects, the rules and regulations announced by the uh, different we can say the bodies like the we can say the IFRS or GAP, or we can say the Institute of the Chartered Accounts of India, ICAI. So these are the bodies who make the rules and regulations for the financial reportings. Okay. So in that sessions, we are going to understand so what are the qualitative we can say aspects required while formulating the financial statements. Any financial statements, what qualities that financial documents require, that we can say it is authenticate and the full proof for financial information of that organizations. As we all know that the many stakeholder uses these financial statements, financial documents to take the different decisions. As in the last session, so we understand the different stakeholders, that is the investors, uses the financial statements to check the financial positions of the organizations or to check the we can say the profit or loss situation of the organizations. If they found it will on that basis they take the financial decisions. We can say that some of the creditors who uses the financial statements to check the credit worthiness of the organizations of the company. uh, okay, if they found the credit worthiness of the organization is not good, they'll not provide any material uh, any raw material on we can say on the credit basis to that organizations. Okay, same likewise the top management uses these financial statements to take the different decisions, that is we can say the expansion of the business or we can say the increase the productions of any product, or to raise the we can say the funds or the capital into the share market. So all of the different decisions are taken by the management of the organizations of the company. So these are the different decisions taken by the different stakeholders on the basis of the financial statements. So the financial statements, as we called as, must be the full proof document or the authenticate documents. Okay, should not includes any misinformation or the misguided we can say statistics in the financial statements documents. Okay, so what qualities that any financial documents required? So that we are going to discuss in this sessions. Okay, so we can say the foundation for the useful financial information. So what is the foundation for the useful financial information that we are going to discuss? That we can say the financial statements must have some of the qualities. Then and then only we called it as we can say the authenticate financial document that financial qualities, like we can say the understanding. So the financial document should not be a complex document. Okay, it should be easy to understand. So the accountant or the financial expert who are in a position to prepare the document, so who has we can say the responsibility to prepare that financial statement, should keep in mind that the document should be easy to understand. Okay. So understandability of the document, we can say, should be there, and avoid mixed, we can say, the complexity in the documents. Now, next one is, we can say, the materiality. That means what information matters to take the firm financial decisions. That must be, we can say, the precisely stated in the document. Uh, for example, we can say the assets and liabilities should be specifiedly mentions. We can say the profit and incomes. So these are some, we can say, the required information to take the decisions for the stakeholders. So these, we can say, the material stats should be there in the financial statements, so that the stakeholder who uses the documents should, we can say, easily identify that material information, and based on that they'll take the different financial, we can say, the decisions. Okay. Now next one is the faithful representation. So so whatever written in the financial statement should be faithful. We can say the no misinformation or misguided informations, or we can say the, the companies never, we can say, don't show the, we can say, the income and the profit overstated, or the, we can say, liabilities and losses understated, so the investors invest amount in their organizations. Okay, so companies should avoid these things to, we can say, to misguide the investors, to misguide their creditors, okay, to misguide their management. Okay, so faithful representations must be there. We can say there are some supporting pillars to the financial statements. We can say then and then only we call it as, we can say, the faithful documentation. Faithful financial documentation, that is, we can say, the neutrality. That means there are no biases includes while the preparation of the financial statements. Okay, though, so the financial statement should be a neutral documents. Okay, then and then only the financial statements correctly guide the other stakeholders, like the investors, editors, management, and governments, that is the different regulatory bodies, and then on this. Okay, if the document is the neutral, so the accountants and the financial experts who prepare the financial statements keep in mind that the document should be a neutral document, that is free from the biases, and we can say it is a neutral document. Now, next one is, we can say, the prudence. Okay, so prudence is the quality of the financial documents to avoid the, we can say, the overstating and understating of the financial informations. Financial information, such as, we can say, if the any organizations overstating its profit and revenue, okay, to misguide the investors, to misguide their shareholders, their, we can say, their owners of the organizations. Okay, so that may me guys misguide the owner. Okay, and if they understated the losses and the liabilities in the organizations, we can say, to keep the secrets of their losses. Okay, they think that if they show the liabilities and losses is on a high number, so they may lose their shareholders. They not able to order the material on the credit basis. Okay, so the document should be a, we can say, the prudence document. That is the exact values, those which are real. That values only includes in the financial statements. Now we can say the final structure when we include the understandability, that is the materiality, faithful representations. we can say the utility, prudence, and all these qualities we include into the financial statements. Now we near to the final structure of the financial statement. Final structure of the we can say the balance sheet or the income statements or the we can say the final structure of the cash flows or the final structure of the changes in the equity statements. Okay, so final structure should be a there should be a completeness in the final documents. Okay, the financial statement should not be incomplete because from the incomplete information, so no conclusions can draw by the different stakeholders. Okay, who uses the financial statements to take any decisions. The incomplete statement is misguide may misguides the different stakeholders, or he is not in a position to take the final decision. So complete financial documents can only well guided to the different stakeholders. So the completeness should be there in the financial statements, and we can say the enhancing, we can say the characteristics. The good financial statements uh, guided, we can say the realistically and well guided to the different stakeholders. So these are the foundations qualities of any financial statements or the financial documents required to be called it as the useful, we can say the faithful financial document. Okay, and then only the document is useful for the different stakeholders to take any decisions. Now, why we can say the qualitative characteristics for the any financial statements matters. Okay. Why this qualitative we can say these features, these characteristics must be there in the financial statements uh, because the financial statements guide the billions in the economic decisions. Okay, there are we can say the billions investors who refers these financial statements to invest their hard-earned money. Okay, as in the subject that is securities, we can say analysis and portfolio management. We learn that the investor first have to analyze the financial position of the organization before doing it. Okay, the financial statements are itself misguided or the wrongly placed, and then the investor cannot take the we can say the right decisions. Okay, so the usefulness of the financial statements not depends just on the numbers, but on the how information is presented and perceived. Okay, so that is also the we can say one of the major part how the information is presented. If the information is we can say the well structured, well presented, then the different stakeholders easily find out the numbers what they require to take the decisions as we understand the prudence quality. The prudence quality we can say uh, told us that we can say the real numbers must be there in the financial documents. Okay, so these quality traits to ensure the clarity, relevance, and the trustworthiness across the global markets. Okay, so for investors, we know the help for investors, the financial document helps to invest, made his investments and calculate the risks associated with his investment. If the financial document is wrong, then he is not able to calculate the potential risk. Okay, how much risk for his investment is present there. Okay, if he is not calculate the accurate risk, he may have the huge losses in the upcoming times. So that's why we require the we can say the qualitative characteristics for the financial statements. So that's why these matters. For the creditors, as we know that whenever the organizations require the raw materials, okay, for any production purpose or the service productions, they borrow the raw material on the creditors. Okay, when the creditors supply the raw material to the organizations, to the company, then there is the credit worthiness of the organizations is good. Okay, and where the creditors analyze the creditworthiness of the organizations in the financial statements. But if the we can say the financial the credit worthiness is the we can say is the misguidedly placed in the financial statement, then the creditors will have the huge losses in the upcoming times. So for that purpose also, the quality of the financial statements should be we can say the good quality. Financial statement must be there, the clear defined, and the we can say the realistic data should include in the financial statements. For management, the management is responsible to take the we can say the main strategic decisions in the organizations. Okay, they are responsible to allocate the financial we can say the finances for the different businesses. Okay, so they are responsible to take we can say the final calls in the businesses, the decisions like the mergers, acquisitions, expansion of the business, increase the production. Now we can say uh, launching of any new products, any any new goods or the services. Okay, so these are the decisions, the main business decisions taken by the management. And management will take the decisions based upon what the numbers they found in the financial statements. If they found the numbers are good, okay, so they will take some of the bold steps to expand the business, to increase the production. We can say to launch the new products and services. And if the information is misleading placed or the misinformation there is available in the financial statements, automatically the decisions taken by the management, we can say, may hamper the futures of the organization. The organizations may have the huge losses in the upcoming years. So if the we can say the realistic numbers and the well structured information were presented by the accountants and financial experts to the management, and then only the management can take we can say the such a decisions which are in the favor of the organizations. And then only the organizations will have the good business in the upcoming future. They will have the good revenue, good profit. But the financial informations uh, must be realistic. Uh, why if the any organization is having losses and liabilities currently, uh, if the show is accurately, then the management or the financial experts will take the decisions to reduce the losses and to reduce the liabilities. If the information is, we can say, the misled and they shows there is no liabilities and no losses, so the accurate step will not be taken by the management and financial expert to reduce that. And if the trend goes on, we can say some years, that is the 10 or the 15 years, and after that, if the information claims out that the some of the data was can say not realistic and the misguided by the accountants and the financial experts of the organizations, okay, then the companies will have the huge losses in that 10 years. So the financial information must be a realistic. Okay, whatever the accountants and the financial experts found, that only they must put into the financial statements. Okay. Now next one is we can say what are the qualities that any financial statement must have. Now we understand all these qualities first, and then we understand the other aspects of the financial statements. First one is we can say the understandability. That is the clarity for all users. So whoever we can say uses this financial statements for different purposes. As we all know, the all the stakeholders have their own purpose. Okay, investors have their own purpose, creditors have their own purpose, management have their own purpose, the regulatory bodies have their own purpose, government have their own purpose. But whatever purpose they are, we can say uses their financial statements. Okay, so clarity should be there in the financial statement. So there is no complexity. So the easy to understand document if available. So they can we can say fulfill their for whatever they uses the document. Okay, so the understandability, we can say, the for the clear to have the clear understandability, there should be a supporting notes into the documents. Okay, so the complex items require the additional explanation through footnotes that breaks down the sophisticated accounting treatments. Okay, many of the times you guys have experienced that you note the, we can say, the you we can say put the small notes while the preparation of your balance sheets, while the preparation of your, we can say, different type of this statement, that is the professional loss account. Uh, for example of the note, if you are taken that you take the raw material on the credit basis for the 2 months, and after 2 months you will give that payment. Okay, so you write it in a note that it is, we can say, it is the credit purchase, and after the 2 months you will give the, we can say, the exact amount to your creditors. So all these notes gives you the exact information. Okay, so when there is a, we can say, the exact payment of the amount you have done. So these are some of the supporting notes must be present in your financial statement that gives you the clear understanding. Okay, if you miss that note, that if you paid, you make the payment after the 2 months. So what you assume that at the time of purchase of the raw material, okay, you made the payment, but it is not, we can say, the correct one. The correct one is after 2 months you made the payment. Okay, so these notes, we can say, is a well guided information for any stakeholders. So use the supporting notes while the preparation of your financial statements. We can say the first one is the avoid jargon. That is, the technical terms should be explained or simplified when possible and ensures the comprehension by the broader audience. Okay, if some of the technical terms, like as we know that the different organizations have the different organizational terms. Okay, the software organization has some, we can say, different technical terms. Okay, so the if the business is the FMGC, they have the different technical terms. So the technical terms should be, we can say, be well defined. So who the stakeholder is read the information, clearly understand what it is. Okay, so here one real world example is given in the PPT. There's the Apple is the organization name. As you all know that Apple is, we can say, by, we can say, by the valuation, by the capital, Apple is the, we can say, the topmost organization in the world. That is the number one company in the world. We can say by the revenue capital. Okay, so what Apple is doing? Apple includes the clear explanation of the revenues recognition policy for multiple products and services in its footnote. As we all know that the Apple is, we can say, very famous for their mobile phones, their Apple series. So every year they launch their new Apple iPhone, but it is not the case that they are earning their revenues by just selling the mobile phone. They earn a revenue by the different products and services also. They have the iPhone, iPods, they have laptops, they have the Apple Watches, they have the Apple Cloud services. Okay, so these are the different services provided by the Apple, and by these different services, they earn the revenue. Okay, so they clearly mention in their financial documents, that is, they add the footnotes. Okay, and they avoid the complex arrangement. Okay, and they increase the understandability of the documents. Okay, by providing which service they generate the revenue, by selling which product they generating how much revenue, and all these things, these are clearly mentioned in their financial statement. Okay, so then we called it as, we can see, the faithful representation of the financial statement, and we can see it is a faithful document. On that basis, the all the stakeholders can take the, we can say, the good financial decisions. Uh, Now next one is we can say the materiality, that is the focus on what matters. As we all know that there are the numerous things which are available in any financial statements. Okay, there are the we can say the multiple things which are available in the financial statement, but the many we can say the some of the things are very important for from the stakeholders point of view, from the investors point of view, from the creditors point of view, from the management point of view, or from the we can say the regulatory bodies point of view. So these we can say these material information we can say must be clearly stated. Okay, so uh, that guides the stakeholders to take the decisions. If, for example, if here we take the two examples that the 1 million uh, in a 10 billion company. Okay, if I invest the 1 million in a 10 million company, then I only invest the 0.01% of the total amount. Okay, so I don't have, we can say, that much influence in the management, or we can say it is not a very huge amount for that organization because the valuation of the organization is already 10 billion. But if I invest the 1 million in a 5 million company, then I will have the we can say the 20% of the total stock. Okay, so that means in that case that I am the influential investors. I can affect the decisions of the organization. So such a type of information must be clearly stated. Okay, so we can say the revenues of the organization, profit of the organization, asset of the organization, liability of the organizations. All these are, we can say, the material information, okay, which you directly uh, guided you to take the different, we can say, the decisions in the business. Now, next one is the faithful representation and figures. Okay, when we called it as the document is, we can say, is a faithful. The financial document is a faithful, and what are the different pillars? On that basis, we consider it as a faithful document. And then if the financial statements fulfill these, we can say, conditions, then and then only we called it as the faithful document. What are these? We can say the pillars. The financial information we can say must accurately depict the economic phenomena. Okay, to fulfill the criteria of the faithful representation, the three conditions here given, that is the complete. As I told you, the incomplete document may misguide the different stakeholders in their decisions, or they are not in a position to take the final call or the final decisions. Okay, so the completeness, all the necessary information is if we can say included or present in the financial statements, then and then only who uses that financial statements can able to take the decisions. Okay, the incomplete decision may misguides. Okay, so the completeness we can say is one of the criteria who tells us that it is the faithful document or the faithful representation of the financial statements. Next one is the neutrality, that is the free from all the biases and the manipulation. Okay, so the accountant or the financial expert, if he bias towards the revenue and the income, he don't want to show the less revenue and the less income for the organization, to show his competitors that they are earning the more revenue than him, they are generating the more profit than these organizations. Okay, so this is the bias decision. The accounting must be unbiased. Okay, to show anyone, any competitors, any organizations, if he takes the decision, it is a biased decision. So the accountant's decisions, financial expert decisions should be unbiased one. Then and then only we will get the faithful financial documents. Now next one is, we can say, the free from the errors. Okay, so if the errors we can say included in the financial statements, okay, they may mislead the stakeholders. Okay, the stakeholder decisions may wrong in the future. If the misinformation, if the errors available in the documents. So if the financial statements fulfill all these criteria, that is the completeness, neutrality, and the free from the error, then we called it as the faithful representation. That is the truth in numbers and words. Okay, your number, what is what is we can say the stated in the financial document should be a real numbers. Okay, what the accountants see, and then only he puts that same number into the financial statements. If he we can say biased one, if he put the misinformation, then it hamper the organization itself in a long run. Okay, the accountants or the financial experts think that he is benefiting the organization by putting the we can say the unrealistic information, but after the we can say some time, some years, the informations came out, and then the organizations have a huge losses. So in long run, this wrongly we can say state misinformation will hamper the image of the organization, reputation of the organization, and the overall wealth of the organization, overall profit of the organization. They may lose the customers, they may lose the we can say the confidence of the investors, they may lose the confidence of the we can say their creditors. So the faithful representation is must required for the financial statements. Now we can say the we can say the economic reality. What is the truth that only must be present in your financial statements? That is, we can say the revenue recognition. If you see the first point, that is the revenue should be recognized when economic benefit transfer, not necessarily when contracts are signed or cash received. If, for example, if you take any example, if you take any contract from the government to build the road, okay, it's just a contract. I made any contract of if I am having the construction company, construction I do a contract with the government to build the road, to build a highway of the 400 crores. Okay, it's just a contract. But when I'll receive a revenue, when I'll receive a payment, when I actually build the road. Okay, but if I place that 400 crore in my, we can say the financial statements in my, we can say the profit and loss account, if I place that revenue, then we can say it is a mislead information, because until we can say till date I am not get any payment from the government. Okay, when I will get the payment, then I construct the road, when I submit all the bills to the governments. Okay, then government pays me the revenue, and then only I am in a position to put that information into my financial statements. Okay, so whatever information any organizations we can say put in their financial statements should be a we can say the authenticate one. Okay. Next one is we can say the neutrality, that is the free from the biases. The information we can see which present in the financial statements must be presented without any we can say the emphasis of that information or the manipulation, because that we can say mislead the informations, and they may we can say influence the users towards the predetermined outcomes and decisions. Okay, and that may hamper their we can say the long-term benefits. Okay, so investors have the losses in the investment, company have the losses in the reputations, image, and the losses in the revenues and profits and all these things. So your information which you includes in the financial statements must be a we can say unbiased one. That is the neutral information must be there. Okay. Now next one we can say that is the prudence. That is the cautious judgment without the we can say the pessimism. That means what is mean by prudence? That you are not we can say overstating your profit and assets, Okay, yeah, if you want to expand your business in some of the cases that the companies overstated their profit capability. We can say to have the investor confidence in their organizations because they want to raise the funds through the share capital. Okay, and when investors have a confidence to invest his money into that organization, then there is a good revenue and the profit of the organization he sees in the financial statements. Okay, so in some of the times the organization misplace or the misleads the revenues and their profit and they are overstating their revenues and profit. Uh, okay, and if and they are understating their liabilities and losses. If they think that if they shows the exact number of the liabilities and the losses, the investor may lose investment in we can say investor may lose confidence in his organization, and the investor will not invest his amount into his organization. So that's why the organization do such a frauds or do such a biases or mislead the information. But we can say the prudence practices shows that we show the exact numbers. Okay, so in prudence practices we can say the provision for the doubtful debts and the based upon the historical defaulters. Okay, so the company should made the provisions for the doubtful debts. Okay, based upon their we can say historical data. If they do that, then we can say they can reduce or minimize the doubtful debts, and they in the coming days they can be we can say the fully eradicate the doubtful debts. Okay, so these are some prudence practices. The inventory valuation accounting for the potential equivalence. Okay, so your inventory valuations or the calculations must be exact what you have. We can say without the, we can say the biases. Okay, so these are the we can say the prudence we can say characteristic of the financial statement must have. Now next one is the completeness. The financial statements always show the whole picture of the financial position of the organization, not the we can say the half one. Uh, if the financial statement shows the half informations, we can say the incomplete informations of the in the organization. Okay, so that may we can say hampered the organizational image. Uh, the all the necessary information that is required for the financial statements must be included for the users to understand the we can say the real financial or the exact financial position of the organizations. Okay, so the omission of this we can say some of the factors from the financial statements can mislead the users if he presented the data is accurate. Okay, if who is referring the data, those stakeholders who is referring the data, he thinks that that is he presented the data, he presented the data that is it is accurate, but it is actually a we can say a mislead information or the incorrect information because the, some of the informations were omitted from the financial statements. Okay, so uh, what we think that the completeness characteristic must be there for the financial statements. Mm, okay, to have the good decisions for the different stakeholders. The complete financial reporting requires to disclose the both favorables and the unfavorable information. If the organization thinks that some of the favorable information, that is the losses, we can say the liabilities, these are the unfavorable informations for the organizations. If they we can say disclose that information that hampered we can say their position in the market, confidence in the investors, okay, confidence to their competitors, okay, competitors to their customers, and all these things. But in we can say in financial reporting, what we can say expect from the organization, they must disclose both type of we can say information, that is the favorable information and unfavorable information. Okay, so then and then only we called it as we can say a good financial statements. Uh, Here is one example. We find out that the company must disclose the pending litigation that could significantly impact the future cash flow, even if the management believes the negative outcome is likely but possible. Okay, even if the companies think that by publishing or disclosing this data, that may hamper, we can say hamper the financial position of the organization's revenue, profit, or they may impact the negative outcome. But the exact we can say disclosure of the realistic data should be there. Okay, so the no misinformation included in the financial statement, and the incomplete information must be avoided. Now, now we can say which are the characteristic required in the financial statement to boost the, we can say, the usefulness. Okay, see this we can say characteristic that is if these characteristics they are with the financial statements, then they automatically in sessions we learn that statements is in the organization they use the, we can say, the uniform format to formulate their financial statements over the year. Then it is the comparable statement. Okay, in I think in financial statements we also learn we can say one of the model, that is the we can say the comparative financial statements. Okay, in comparative financial statement we compare the data for over the period of times. Okay, we check that revenue is increases over a period of time or decreases over the period of time. So what we do, we collect the 10 years we can say the profit and loss account or the income accounts, and in that statements we check the revenue is increases over a period of time. If we consider this 2015 to 2025, so we collect the financial statements for over 10 years, and then we analyze that the revenues increases or not, or decreases, or profit is increases or not, or decreases. What is the exact situation? So on that situation, the top management can take the different decisions. Okay, so this is we can say one of the characteristic the financial document must have to, we can say, have the we can say the comparability of the financial statements. Okay, if we can say to compare the two organizations, two competitors, if the two companies, we can say, they producing the same product, or they are providing the same services. For example, if we take the Apple and the Samsung, these are the two brands who competes in the mobile phone industry on the international levels. We check that the number of sales of mobiles each year they are doing, uh, what is their revenue, what is their profit. We will make all the comparisons. We can make all the comparisons if they follow, we can say, the uh, same, we can say, the uniform financial statement uh, to prepare their financial informations. Okay. Now, next quality is, we can say, the verifiability. That is, whatever included in the financial statement must be verified by some other individual or some third party. That is the we can say what is we can say the direct verification. That is the whatever include in the financial statement must be directly verified. If the company says that we will have that much revenue, okay, so one financial expert must verify the numbers. That is the checking the amount through direct observations, and we can say if the company says we sell so that much product, So we can directly count the physical product that the if they sells that much or not, or how much revenue they receive directly into their banks, and all these things we can directly check. Okay, in direct checking, what we found, uh, whatever the mislead information, so the organization include in their financial statement, or what is we can say the omission of the information, what they omitted from the statements, that also we can find it the direct verification. We can say the by using the different tools, okay, by doing different ratio analysis, or we can say by applying different formulas and other techniques. The techniques like we can say the recalculating the depreciation or reviewing the valuation methods, and by using all these methods we can. Okay, now next one is the external audit function. So as you all know that there is, we can say, one of the external auditor who audits the company. Okay. Uh, whenever the independent auditor, that is the auditor who is, we can say, outsider, who is not from the organizations. Okay. When he audits the different financial statements with the, we can say, the exact numbers, okay, then he find it out the information is misguided or not, misled or not. We can say the misinformation is available or the bias information is available in the financial statements or not. Okay. So the we can say if the verification is not there, we can say the checks is not there. Okay, so we can say the possibility of the inclusion of the misinformation increases. But every company knows that for the whatever they are going to include in the financial statements will check by, we can say, by the direct verification or by some external auditor. So if they knows that, then they includes the realistic information, because they know that while doing the verification process, it may, we can say, find it out that they mislead the financial statements. Okay, if these three, we can say, characteristic, we can say we use that is comparability, we can say the verifiability, all these things gives the, we can say, the characteristic to boost the usefulness of the financial statements. Okay. Now next one is, we can say, the timeliness of the financial statements also gives us the, we can say, usefulness to, we can say, to boost the usefulness, that is the information when it matters. Okay. When I required any financial information to take the decisions now, I have some amount, I have the 10 lakh rupees I want to invest in some organizations. For example, if I want to invest that my amount is with the Infosys, but the financial statements of the Infosys is not present in the, we can say, the present time. Okay, so now it is in the process. So what will happen? The Infosys lost the one investor. So, the timeliness is, we can see, one of the major factor that the, we can see, the preparation of the financial statements on a time. Okay. Um, the completion of the financial statement on a time, that gives, we can say, the information to different stakeholders. Whoever wants to take the different decisions can, we can say, use these financial statements. Okay, so the financial data must be available on time. Okay, so whenever the, we can say, the stakeholder wants a data, that is, we can say, because of the financial data availability will influence the decisions of the stakeholder. Okay, so in for if we can see the data is not available, so it is not possible for the different stakeholders, that is the investor, we can say, the creditors, management, to take the different decisions. So timeliness, one of the factors which is we can say importance of the financial statements. Now we understand, we can say the easy to understand. Okay, the visual representation from that financial statements, we can say we make the different graphs, charts. So as you all now know how the charts and graphs we can say interpret the data. Uh, in your field project and OGT, you now knows how information puts into the graphs and data, and on the basis of the data and the graphs you interpret different conclusions. Okay, you draw the interpretations. Same likewise the financial experts we can say, or the different stakeholders we can say. Now if the company draw the different graphs and charts on the basis of the data and put that information to their financial information, then it is easy for the stakeholders to take the different decisions. So his efforts reduces because the data is already is available to him. That is easy to understand. Okay. Now next one is, then you can say the executive summaries. If you guys see the annual reports of the organizations, in annual reports you see all the informations. That is, you see all the we can say the financial statements. That is the balance sheets, profit and loss account, cash flow statements, and also they gives you the executive summaries of their financial statements. They gives you the visual representation, graphs, chart. In upcoming sessions, we will see one of the annual reports of the organizations. On that basis, you can understand that how organization shows their financial informations to the different stakeholders. Now, next one is the clear language. No, we can say the hectic or the complex language. We can say the must avoided by the organization so that the any stakeholders, okay, who can understand language. Now we can say the logical organization, that is the structuring information on a we can say in a such a simple manner with the appropriate headings and sections improves the navigations. Okay, so we can say the differentiation of the data and different headings the data must be available. So whatever requirements any stakeholder wants, so he can easily find it out. Okay, so we can say, so this is uh, here we sum up the first chapter of the financial reporting. Okay, so in next sessions we starts with the we can say the different types of the standards we used while the any organization doing the financial reporting. Okay, if you guys have any questions, you can ask. Okay, so there is one instructions for the finance students. You have to screenshot. We can say you have to take the screenshot and send the same screenshot to your mentor. That is, those are those students who are under the Thorax sirs, who need to take the screenshot and send the same screenshot to their group. And those who are the mind mentors in the finance specializations, who need to take the screenshot of the every sessions, and they need to send it on a group. So I will make the arrangement that you are capable of sending the screenshot on the group. Okay. Okay, now you can leave if you don't have any questions. If you have any questions, you can ask. Okay, if you don't have any questions now, you can leave the session. Thank you.